Okay, this is Business 342, homework page 89, problem number 10. Western Electric has 50,000 shares of common stock outstanding at a price of 48 bucks and a rate of return, this is RE, because this is equity, of 14.2%. Now notice they're saying rate of return. It's rate of return or cost of equity, depending on whose side you're looking at it from. The firm has 6,000 shares of 7% preferred stock, outstanding price $48 a share. The preferred stock has a par value of 100. Remember, you need to know the par value because you need to figure out what the dividend is, and the dividend is based on the par value, not the current price. When they issue it like a bond. They're paying 7% based on the face value, the par value of 100 bucks. So it's $7 per year. It's not based on this. The $7 over this will give you the yield. The outstanding debt has a total face value of $300,000. So they're saying the total bonds have a face value of $300,000. We know that bonds go for $1,000 a clip, so that means there's 300 of them out there. And currently sells for, okay, so this doesn't matter. In this case, what they're doing is telling you the face value is $300,000, but they're telling you that it currently sells for 102%. So you're just going to take that 300,000, multiply it times 1.02, because 100% would just be 300,000 again. 1.02 will get you the market value. The yield to maturity on the debt is 8.2%. The YTM, so that's the same as the IY, remember? This is how you figure out the IY. When you figure out the IY, it gave you the yield to maturity, so that's the same thing. So you've already got that. What is the firm's weighted average cost of capital if the tax rate is 34%? Now remember, they gave you the yield to maturity, which is the IY right here. So you don't have to go through those calculations. Okay, so the first thing you do is want to figure out the market value of everything. So equity, 50,000 shares times, remember you always figure it out based on the market price, 2.4 million. They tell you right here that RE, the cost of equity, or the return, the rate of return, either way you want to say it. R actually stands for return, but from the company standpoint, it's the cost of the equity. From the stockholders' standpoint, it's the return of equity. Return of equity. Not return of equity, that's ROE, or return on equity is ROE, but just return for equity. Okay, preferred, the value of that is there's 6,000 shares out there. Current price is $48, so that's $288,000. The RP, the return for preferred, is the $7, which is 7% times the par value over the current price, so it's 14.58%. And then the debt, they told you the face value is $300,000. They told you it's 102% the current price. So 1.02, that gives you $306,000. You add these together, that adds up to $2,994,000. That's the V. Remember, V is the total value. And remember, since they gave you the yield to maturity, that's the same as the RD, the return you get from debt, or the cost of debt, depending on whose point of view you have, of 8.2. So they've already figured that out for you. Now they get the after-tax cost of debt, the RD times 1 minus the tax, 8.2 times 1 minus 0.34. So the after-tax cost of debt is 5.42. Now remember, the WACC, the weighted average cost of capital, is the weight of equity, which is equity over the value, times the equity return, the rate of return for equity, plus the weight of the preferred, which is the market value of the preferred over the total value of the asset, or the not the assets, but the total value, times the return preferred, return of the rate for return for preferred, plus the weight of the debt, which is the total value of the debt over the total value of the company right here. Now times, you could times RD times 1 minus the tax rate, or if you've already figured it out, this subs in for this whole thing. If you've already figured out the after-tax return, then just plug this in for this whole equation part right here. If you haven't, then you've got to take the RD and multiply it times, do the same thing you did here basically. But now you've already done it, so you just plug this number in for this whole part right here and multiply it times the weight. So you know how to get the weights. It's just, for equity, it's 2.4 million over 2,994,000 times the return. The weight for for preferred, 288,000 over 2,994,000 times the return for preferred, and the same for debt, the weight times, and this is just giving you a weighted average. It's really simple. And so the weighted average cost of capital is 13.33 or 13.34, depending on where you rounded it, percent. So that's problem number 10, page 89 of your Business 342 workbook.